Our program today is a continuation of our look at the impact of the pandemic on our community, this time from the perspective of the banking industry. Here to introduce our guests from Washington Trust Bank, please welcome fellow Rotarian and past president, Jim McCurdy.
Thank you, President Kim. Good afternoon, everyone. As many of you know, I had the opportunity to serve in President Kim's role about 7 years ago. Of course, I did that from a podium rather than a computer screen. At that time, I had the opportunity to showcase my employer by having our chief economist, Steve Scranton, speak to Seattle 4, and he did a great job. Well, the bank is back today with a double header. It's my pleasure to introduce Jack Heath and Kevin Blair. Jack is president and COO of Washington Trust Bank and also serves on its board of directors. He assumed his current role as president in March of 2000 after an already extensive career with the bank. He's very involved in the Spokane and Washington communities, having served on the board of the Greater Spokane Incorporated, Pacific Coast Banking School, Community Cancer Fund, and Primera, to name only a few of the list. He received a BA from the University of Idaho and an MBA from Gonzaga. Kevin Blair is president of Washington Trust Western Washington region and also director of commercial banking. Kevin joined the bank in 2004, coincidentally the same year that I joined. He joined the bank after stints at Bank of America and US Bank. In his current position, he's responsible for the bank's operations west of the Cascades, which in itself is a $1 billion operation with only 5 offices. Kevin has served for many years on the board and as treasurer of the Seattle Aquarium, and also has volunteered for the organizations such as Junior Achievement. He received his BA from Santa Clara and an MBA from Seattle University. And I might add a special welcome this afternoon to Kevin's mother, Sarah Blair, who is joining us. I wonder if both Jack and Kevin wish they were Huskies. With that, gentlemen, please welcome Kevin and Jack.
Thanks, Jim. Appreciate that very much. And hi, Mom. So that's what Jack and I thought we'd do today is go through some slides. We really think the value in our presentation is listening to your questions, so we know what you guys are thinking in the market, and also sharing what we've hearing from our clients and customers by answering those questions as best as we can. But first, we thought we'd go through just a quick summary and we prepared some slides, and we promised to do them quickly. Just kind of a snapshot of the Paycheck Protection Program, or as everybody calls it, the PPP program. And then Jack's going to talk a little bit about the banking industry and, pre-COVID and this crisis or this pandemic, how the industry looked. And we'll talk a little bit about how the industry looks differently than it did entering the Great Recession. And then we thought we would give you kind of Washington Trust's vision and what Jack and I see a little bit of our snapshot moving forward here as we get back into reentry and as businesses start opening up, and how how things will be different and how people are thinking and working through that. So with that, I think we've got a screen share. Can everybody see that okay? Is that coming through, Mariah, Kim?
Yep.
Yep, we're good.
Great. So let's go to the first, the PPP summary, Jake, if you can. So just a quick background on PPP. This all started on April 3rd with the first stimulus, $349 billion that was authorized by Congress and through the Treasury. That lasted all of 13 days. So really an extraordinary effort to get funds into the system, a level of liquidity into small business that hadn't been seen before. So by April 16th, that first stimulus was gone. It was refunded, or it was restocked, I say, at $349 billion on April 27th. So a total of $669 billion of federal funds into small business owners' hands. And as of this was as of last week, our Washington Trust, we tracked the 3 markets we're in, which is the Pacific Northwest, Washington, Oregon, and Idaho. And you can see the totals, 12.1 billion in Washington, Oregon at 6.8 billion, and Idaho at 2.6 billion in total funding. And as of today, the program is set to expire at June 30th, and there's roughly $100 billion left. So it'll be kind of the sooner of June 30th or that $100 billion. So Jake, can you take us to the next slide? So the way this works was Congress authorized the funds that moved through the Treasury. The Treasury used the Small Business Administration as administrators and used the bank as kind of the deployment of the funds. So that's really, you know, how this has worked to get the funds deployed into the communities as quickly as possible. And I think this next slide is interesting in the sense that it's been a very fluid process. So anybody who's been involved in this understands that. And by fluid, I mean ever changing. So this, if you can just see, there's 11 different interim final rules or IFRs from the SBA. So these are all updates and changes, modifications, answering questions to the program that, as I said, started April 3rd. And you can see through May 20th, we have 11 different updates and changes. Most recently on the forgiveness piece, which is what everybody is starting to focus on now that they've had their funds and been spending these monies or holding these monies. But we'll talk a little bit further about that. And then you can see there was an interim final rule from the Treasury as well on April 27th. So the next slide really talks about kind of what we see as the keys as we look right now. For, you know, everybody is focused on repayment for the PPP and the forgiveness. Right now, the way it is set up is as a borrower, or you can submit to your bank. The bank has 60 days to review that. Our bank is, you know, all banks right now are really putting together processes on how this forgiveness is going to work. And our bank hopes to, you know, turn those requests in days rather than, you know, months that they've given. But the banks do have 60 days to review. They'd submit to the SBA. The SBA has 90 days to make a final decision and then 15 days to fund from that. So unlike the beginning of the PPP process, where it was literally felt like a race for funds, and in many ways it was, the forgiveness period is really, as you can see, more drawn out to give borrowers and small businesses more time to react to some of the changes that are coming through. And some of those key changes right now that we think make a lot of sense that are sitting in front of Congress, you know, two of the key ones are, you know, I think the program initially was getting liquidity into businesses' hands with the 8 weeks. But the reality is, and Seattle's a perfect example, we're still closed down for the majority of businesses. So the 8 weeks is rapidly coming to an end, and people either have not deployed or, you know, or have not fully deployed their funds. So there's a thought to take that period to 16 weeks. That's currently in front of Congress. There's also a rule that the Treasury put in that you should spend 75% of this on your payroll and 25% kind of on other, like rent or utilities. There's a thought or legislation to eliminate that, because what that's doing is limiting people's ability to apply for forgiveness because they can't deploy those monies to people that literally are sitting at home. And also there's other things like unemployment and benefits there that people are taking advantage of that help make it difficult for the 75-25% limitation. So those are changes that we hope will get through and pass through Congress in the next 2 weeks. We think they make a lot of sense, but things you can do, because we think those things help small business, is, you know, you can contact your congressional representative. You know, our voices and your voices are going to be important through this process because that's really what the SBA has been listening to via the banks, and Congress listens as well. And the key thing, though, as a small business owner, is really to keep detailed records for reimbursement. As you deploy these funds, it's a great practice to make sure you know why you're deploying them, where you're deploying them, and make sure you're documenting that through the process. And, you know, a third thing that we didn't put on the slides, but, you know, our recommendation is not to rush for forgiveness. We do have some time. If we look at the next page, Jake, the next slide, it shows kind of the process here. And really what it shows is that small blue box in the left corner is the 8 weeks to spend. We hope that'll get modified to 16 weeks. There's an interest accrual for the first 6 months at 1%. Any funds that are forgiven, it's principal and interest. So you have some time as a small business owner to see how these rules lay out before you apply for forgiveness, and make sure you're documenting everything that you're doing. And then if there is an unforgiven part, there's an 18-month repayment period as it currently sits. So that's the 24-month kind of term loan for this program. And like I said, the funds there's $100 billion left. So if you have a small business and you have yet to apply, I would certainly recommend that you get with your CPA or your legal and work with your bank to get that PPP loan in. Because that will end June 30th as it is, or until that 100 million runs out. So that's the background on PPP. And Jack, I'm going to throw it over to you to talk a little bit about the banking industry, because I think we think that's important as well, and how positioned the banking industry was going into this current pandemic.
Thanks, Kevin. And maybe before we touch on that, as I was watching the chat, I saw a couple of questions pop up that I could touch on real quickly. And that was, were there limitations of when businesses could get into the PPP program? And the answer is yes to that. For sole props and smaller businesses, it opened the 10th for the first round and closed the 16th, which made it challenging. We were able to get all applications that we received through, but many small businesses weren't able to participate in that first tranche and now have been able to do that. They also asked the question of how many of these businesses were small businesses in CRA areas or versus large businesses. We did $1.3 billion, $1.5 billion in commitments, and $1.3 billion in total loans, 5,004 total loans. And of those, 4,242 were smaller business in the 350,000 and below category. So our emphasis was really to get this money out to sole props, small businesses, and to nonprofits who really needed that funding. So the other question that was asked is about the 8-week limitation. And as Kevin touched on, we're working hard with the congressional district to get that extended to 16 weeks, because that would give people more of an opportunity. The 75% towards payroll, 25% towards other expenses also was something that the Treasury put into the legislation, but the Congress had not approved. So we're hoping to get that eliminated to make most flexibility possible for small businesses to use that funding. So a few answers to a few quick questions there. Maybe next slide is just to talk about the banking industry as a whole. And Jake, if you could go to that next slide. If you look at this, you can see that the capital position of banks has grown significantly and the earnings has been very, very strong. And I think having gone through the 07, 08, 09 crisis, all banks kind of focused on rebuilding, particularly community banks, a fortress balance sheet, because we never wanted to find ourselves in those positions again. And then in addition to that, if you go to the next slide, you'll see delinquencies. We went through a very high spike there. The economy returned significantly, and profitability on banks now is at 10.58%. So coming into this pandemic, we're in a stronger position than you've seen banks in the past. And so, Kevin, do you want to touch on the next slide?
Yeah. So, I mean, at the next slide that talks about is really, the banking industry, and we all are as businesses, no stranger to difficult times. So we put this together and internally, there was the thrift crisis in the late 1980s where there's 1,100 thrifts that failed. Those of us on October 1987, the Black Monday, where the stock market crash was down 22% in a day. 1998, there was the collapse, the long-term capital management that nearly bankrupted the entire global financial system, which we saw again at the precipice of the Great Recession. 2000 was the dot-com burst, and the NASDAQ down, over 80% in a little over 18 months. 9/11, the terrorism attack and the shock to the system that created initially. Again, the Great Recession, that of 2008 kind of through 2012, where we, had negative returns in finance and everything changed there. And then today we have, the COVID-19 pandemic. We're not officially in a recession, but I think we all understand that, once we get through the 6 months, this will be declared our next recession. But when we look at these difficult times, they kind of fall into two categories, systemic issues like the Great Recession and shocks to the system like 9/11. We think what's happening here with the COVID-19 pandemic is more of a shock to the system, because we really believe that going into this, the system was in good financial strength and health. And it's been this external shock that's really changed everything. And really the difference this time, if we can look at the next slide, is the strong economy that we entered into, but the magnitude and the quickness of the shock, with literally shutting down the economy for the last 2 months. But like I said, we think this is less structural and more a shock. And there are many strong sectors, and they still remain strong, like residential real estate. The demand, we're continuing to see demand in the residential accelerate. But there are unprecedented sectors that, are experiencing this, and those primarily, as you look out, is hospitality. If we look at hotels and restaurants, and transportation, airlines, Amtrak, companies like Hertz. It will be very interesting to see how these industries survive through this. And many of the players probably will not, especially particularly in those industries. So one of the things we like to look at is, when we talk about hospitality, is this next slide we think is fascinating. If you look at March 1st, you're talking about, on the top is 2019. This is TSA passenger traffic. And at the bottom is this year. And so you just see the bottom fall out from, basically 2.25 million travelers on a daily basis down to 119,000. So, obviously a shock like that for the length that's gone on is going to hurt into any industry. But that is, those are the issues that we see and the differences between the pandemic this time and other recessions. Jack, I'll throw it back to you.
Yeah, and I think from our perspective, this is a amazing time from the standpoint of we consider this a kind of a accelerant or a fire that's speeded many trends that were already developing, but has accelerated them a huge way. And that really is work from home, virtual meetings, office hoteling, and the impact that'll have. And then also out of migration, out of larger high dense areas. It was interesting, Zillow just completed a survey, and 75% of the respondents said they prefer to work from home. 66% said they'd move to a less expensive city if their employer allowed them to work from home, and 24% said social distancing may drive them to move to a less populated area, which was a fascinating piece. I would say that those survey results were at the peak of the pandemic too, so they might be softened by this point in time. The ripple effect from this on the next slide is that large retailers, obviously those bankruptcies were inevitable, but they got pushed quicker into the system. And the question that we keep asking ourselves is, how fast will reopening occur? And, cities are trying to innovate with restaurants, allowing them to go to the streets and sidewalks to increase capacity, but it's a real challenge. And even with the federal stimulus that's happened, there have been rate cuts and this low rate environment. A question came in around, why are bank stocks down? The stock, Washington Trust is a privately held company, so we're traded under WTBFC. The stock that was referenced in the question actually is an East Coast bank with the same name as Washington Trust Bank. But bank stocks have been adversely impacted by the low rate environment and an anticipation of real pressure on earnings going forward because of loan losses related to the pandemic and because of the low rate environment that we find ourselves in today. So it's a real challenge. And Kevin, do you want to touch base on this next slide?
Yeah. Thanks, Jack. So when we talk about rates, this is a slide we put together. I love this slide. It really shows this is prime rate over the years. You see back in the 1980s, it approached 11.5%. Then you had the S&L crisis with the rates dropping down to around 6%. Rates build back up, to about 9.5% in the early 2000s. And then you have the .com and the 9/11 that drops rates back down to around 4%. The prime builds itself back up to 8.25%, and then that subsequent fall over several years to a 3.25%. And we saw that during the subprime meltdown and the Great Recession, we saw rates climbing back up. As you can see at the very end, it only climbs to about 5.5%, and we're right back down to really our lowest prime rate, which has kind of been our rate environment for the past, for the better part of the past decade. But at the end of the day, going into this, one thing to take from this is, we're at the lowest point of prime rate, and that always puts pressure on banks because, obviously they're making money on the margin. As rates contract, that is going to contract earnings. But also looking forward from monetary policy, you can see how each time the rates have been able to climb up, there's been a general decrease in rates over the, since the 1980s. But going into this recession, you've heard a lot about how there isn't as much monetary strength in rates. As you see, it peaked out at 5.5%. So it's less of a floor to this 3.25% that we're at right now. And if we really want to show, Jacob, you can show them the next slide. This is the 10-year Treasury, so you can see that. Same time period from 1984, the 10-year, over 13%, 13.5%. And who would have thought at any time you just see a long decline in the U.S. Treasury down to the point where we're currently at, 60 basis points, 65 basis points for, a 10-year U.S. Treasury investment. So pretty remarkable times when it comes to rates, and obviously unprecedented as the 10 years as low as it's ever been.
So I think in quick summary here is, the big question that we keep asking ourselves is, are the supplements, the extra $600 a month for unemployment, going to help bolster the consumer? The commercial and loan deferrals that have been done to allow principal and interest to be deferred up to 6 months. And if you know of anybody under stress, the banks are actively providing those concessions to help people through this. And then the next question, which is the next slide, is, what is consumer confidence going to do? And that's going to be the driver to restore this economy. So if you look at that, it had kind of fallen off a cliff, but it feels like hopefully as we go into this re-entry that we'll see a lift in that, which will drive spending activity and help some of these small businesses come back in. I think it's been interesting in consumer behavior. There are a couple of websites we watch, Open Table one and Foot Traffic Trends is another, and they both show that as the restrictions are lifted, activity has peaked and risen quickly and then kind of fallen off. And so the question we keep asking ourselves is, what is the human emotion or psychology that's going to impact that confidence to get people back? And then there's a lot of discussion around the risk of the second wave and the impact of the stimulus from a long-term perspective. But as we look at it, we believe our markets are well positioned, that the hospitality industry is going to be really adversely, and the housing industry, or hospitality and hoteling, is going to be very intensely impacted, and how quickly will it come back for travel. If those things can start to lift, we feel that there's a great opportunity, and we also feel that this challenge is going to be very different region to region. So with that, I'd kind of open it up to questions for the panel, and there are a few that have been laid out here. Do you want us to go ahead and just answer those?
If you would like to read them out and answer them, you can do that. Otherwise, I can read them for you.
Go ahead. We'll let you.
Okay.
Why don't you take point?
All right. I will start going through these. Some of these have been answered during the presentation, so I will skip over them. But one question that came in from David is, how comfortable are you with the program, and I think that's the PPP's ability to detect and avoid fraud, such as with Washington State's unemployment system?
Yeah.
I think that the fraud detection on the larger companies will be very, very good. And I think that any company over 2 million in funds will get audited. I think where fraud could occur is on the smaller side with these smaller businesses, where material that's submitted is maybe not as detailed. But I am not as concerned about fraud with this particular program because of their need to interact with the banking professionals and the information that we're getting. So my hope will be that fraud will be very low. The question will be, are companies getting funding that don't need it? And are well-heeled companies accessing this program? I think they'll continue to give good guidance around that, and we hope that that will not occur. The big question is, in everyone's mind, is how do you describe well-heeled? And if you're bringing people back to work and you wouldn't have done that under normal circumstances, are you allowed to access funding for that program? So that'll be a continuing discussion going forward.
Yeah, and I would just add that, one of the things the banks had to do on the beginning of this was attest that the company was in business and that, they were familiar with the clients. So, and that's why I think you saw a lot of community banks who are set up and know their clients like we know our clients personally and individually. I can attest that there would be zero fraud really through the Washington Trust, because at the end of the day, we know our clients so well. And you saw this program kind of go through with community banks in many areas of the nation leading the funding of this. And I think that the community banks really set up well for this. And the bigger banks, they did it differently than community banks. More, I would say, used technology in many instances more robustly, but still had to make the attestations that of the clients. So, I think fraud, well, I'm sure there will be some issues in there, but like Jack said, I agree. I don't think it's going to be as pervasive, particularly when you start seeing some of the stories around unemployment and the stuff we've seen there.
All right, thank you guys so much. Next question from Bob Wiley is, which regions do you predict will recover the fastest or slowest?
I think that you're going to see, we're already seeing it across our footprint, a lot of the rural communities that have very low COVID cases are coming back very quickly. If you travel into Coeur d'Alene, for instance, Wenatchee, those areas, and you travel back, it's business as usual right now. So the concern will be, does the virus get transferred and what happens? So it'll be an interesting case study in those states that have opened very quickly and are allowing people to just commingle and are not enforcing per se more stringent rules. And I think it'll be an interesting study, but we think that some of these rural markets are well positioned to recover much more quickly.
Yeah, and I think I would add, over the longer haul, we believe, particularly a city like Seattle that's heavily invested in tech, and some of the companies that will most likely benefit, like the Amazons and the Microsofts, the Facebooks. We think that, initially it may be slower coming through, but the strength of the economy and those employers will keep Seattle very robust and a strong economy in the longer haul.
All right, next question then is from Jimmy Collins, and he asks, what can or should we as clients or potential clients be doing to assist the banking sector? That's
a great question. A couple of things is, one thing is help us on this lobbying for small business with your congressman. This 75% limitation on funds and the 8-week period to be able to deploy them through the PPP program is really catastrophic for a lot of companies that entered into the program very early. And if you're a small restaurant, you can't open. And so they really need more time to be able to deploy those funds and deploy those people. So that's absolutely critical. And then the other part is go back business as usual as quickly as you can while being prudent, and support those small businesses and those nonprofits that are in desperate need right now.
Yeah, I would think the other thing I'd add is just, constant communication with your CPAs, your bank, and your legal. I mean, a lot of the issues that we raise up through the SBA is, and through our banking networks come from our clients and customers. So the issues that we're hearing over and over again are the issues we're raising as well. So
I would also say educate your friends that may be having financial issues, that the banks will work with them. There's an opportunity like never before to defer principal and interest payments for consumers, for mortgages, for commercial real estate. We have been given real latitude by the regulators and the CPA Association to really, they've changed those regulations that allow us to be much more flexible with our customers, which is a great thing in this challenging time.
All right, next question is from Jan Levy. She's wondering that your data shows the residential real estate sector remaining strong. Is that trend predicted to continue?
I believe it will. I think rates are very, very favorable, and net in-migration to most of the markets that we work in is going to be very high. So we anticipate that real estate market continuing to do well. And I would also say there's also supply constraints right now. So from the standpoint of new construction and access to lots, as well as inventory, it still continues to be very low compared to historical standards. And if you look back to 2017, where markets collapsed, there was double-digit growth coming into that for 4 years. This time, we've seen more consistent growth in value, so it feels more sustainable.
Yeah, and I would just add, I mean, I have friends that are trying to sell their house, and it's, you know, nobody can list anything, and, you know, as the summer season rolls on, you know, a couple of them are moving or want to sell their place. I think rates being low it helps. I think there's a built up demand for inventory, a lack of supply, and then, you know, also as we look forward, you know, and we talked a little bit, you know, I do think that the area will rebound, and also when we start thinking about it, you know, a lot of people have moved. You know, the desire of a residential or single family residence is kind of growing back, right? Because at the end of the day, people were moving into the city, but now, you know, being closer and in closer proximity to each other, and, you know, apartments or stuff like that may not be as desirable as say a residential home. You know, over the past 3 months, that, you know, consumer preferences may have changed. So.
All right, next question is from President-elect Jeff Boric. Does the level of funds that the federal government is issuing give you pause with respect to the amount of debt, currently $25 trillion, and the potential for inflation?
Absolutely. I think the challenge is, I don't know whether option there was. If we can get the money into the small business hands, and we can get this unemployment benefits were so critical, and the supplement has been controversial, but I think you have to put consumers and businesses in a position to be in a strong coming out of this and be able to drive that economy back. And had they not provided that stimulus, my concern would be that this pandemic could extend for years and be very adverse to the tax rolls, and even enhance that need to fund it for a longer period of time. So it's tough. It's a tough amount of dollars that are being pumped into the economy, but it's critical right now.
Yeah, I agree. I think this is where you spend those monies, is in incidents like this, you know, but one of the things that we talk about in the unspoken thing is really the level of deficit in addition to national debt. And, you know, it's this was something that was talked about, you know, quite a bit over the past decade, and you haven't heard much about it, honestly, for the past several years. But at some point, you know, how much is too much? I do agree that this was the right thing to do, but at the end of the day, you know, that's one thing that I think is going to be a longer term issue and conversation is, you know, how much debt that the U.S. government is carrying, and, you know, when and if that comes home to roost.
Yeah, one thing I'd really emphasize, though, if you know of small businesses that have not accessed the PPP program, minority held businesses, nonprofits, let us know, because we are still open for business and working with non-customers aggressively to get these funds out.
All right, and there was a question a little earlier kind of along those lines, and I just lost it. Oh, here it is, from Kathy. She was asking how many minority-owned businesses and those in low and moderate income areas are included in those receiving the PPP funding.
I don't know the answer to that yet. That data will be coming from the SBA. And if you look at the summary that we provided, the numbers we were working with are from May 16th. So it's been very slow, the data that's coming from the government. But I can tell you across our footprint, it's been a great mix. We're really happy with the number of small businesses and CRA focused areas that we wanted activity to happen. So I think it's been very effective. And I think we've done a lot of outbound education to small businesses in those challenge areas, making sure they're aware of the program.
All right, and one more question from Faith Ireland, that she's heard that the jumbo loans are hard to get. Is that so?
Jumbo loans are becoming more and more challenging, and I think you're seeing some of the large conduit lenders and large banks have kind of exited that market. So I think that pricing has not been as competitive on jumbo mortgages, but we're still very active in that market and have been doing a lot of those loans. In a lot of these metro markets like Seattle, if you can't access jumbo loans, it's challenged buy a home today. So I think that market, although it's constrained, I think that's based on credit concerns people have, and we've continued to be active in that space.
All right, thank you both so much. I'm going to turn it back over to President Kim.
Thank you, Mariah. Kevin Blair and Jack Heath, thank you so much for your presentation today. You guys do a great job co-presenting, and we really appreciate that you were able to take so many questions. Thanks also to Jim McCurdy for introducing our guests. Please join us next week when we will hear from Bob Quinn. Bob is a scientist, farmer, innovator, and Rotarian with the Big Sandy, Montana Rotary Club. He's the author of Grain by Grain, a quest to revive ancient wheat, rural jobs, and healthy food. Bob details his life, mission, and what food costs our nation after we leave the grocery store. Bob was recently featured as the cover story in Rotarian magazine. Thank you to all our program participants. And I want to invite Jack, excuse me, I want to invite our guests to join us in the breakout rooms if you'd like to. So, but before we do that, thanks to our outstanding Rotary staff, Program Manager Mariah Kimpton, Executive Director Caroline Bobanek. We are also grateful to the sponsors of our YouTube channel. Today we thank Gold sponsor Bob Alexander. Please stay safe, stay engaged. Our community and Rotary need you. We are adjourned.